Welcome to this explainer. Today, we are diving into the mechanics of the absolute biggest debate in the financial world. If you've ever logged into a retirement account or a brokerage app and wondered, what's actually going on behind the scenes with your money, you are in the exact right place. We're going to break down the core philosophies of active and passive investing to help you figure out exactly where to best position your cash for the future. No fluff, just the mechanics and the data.
So, let's just cut right to the chase. The ultimate question every single investor eventually has to face when building out their portfolio is this: which strategy actually builds more wealth over the long term? I mean, it's a simple question, right? But the answer literally dictates the trajectory of your entire financial life. Is it the fast-paced, hands-on approach of stock picking, or the quiet, steady rhythm of just holding on to index funds? Well, let's find out.
Section 1. Active investing. The quest to beat the market.
So what does this actually mean? Basically, the fundamental goal of active investing is aggressive growth. This is a very hands-on approach. It relies on forecasting trends, dissecting earnings reports, and timing the market to actively outperform benchmark indexes. The whole philosophy here is that with enough rigorous research and institutional skill, an expert can effectively cherry-pick the winning stocks, ditch the losing ones, and generate a much higher return than the overall market average.
Now, here is the catch. Relying on a team of experts constantly moving your money naturally grinds against your returns because of some pretty heavy logistical realities. Professional management means higher overhead fees, and all that frequent trading, it triggers transaction costs and potential tax liabilities. Plus, when you actively choose to exclude certain stocks and overweight others, you're heavily concentrating your risk. If the manager's predictions are wrong, and sometimes they are, the portfolio suffers a much sharper loss than the broader market would.
Moving on to Section 2, Passive Investing, Riding the Market's Wave.
This is basically the exact opposite approach. Passive investing completely tosses the crystal ball out the window. You aren't paying a premium to find the needle. You are literally just buying the entire haystack. By tracking a market-weighted index like the S&P 500, for example, you're accepting that you'll get the average market return, no more, no less. It's a buy-and-hold strategy designed specifically to maximize long-term returns through extreme, disciplined patience. And because this is a hands-off approach, without a sprawling team of analysts trying to guess the future, the overhead is an absolute fraction of the price. You're really only trading during rare index rebalances, which removes human emotion and predictive error from the equation entirely. It just takes a slow, steady, long-term approach to wealth generation, focusing on the overall expansion of the market rather than trying to catch individual asset spikes.
All right, Section 3, Head-to-Head, the objective comparison.
When we put these two strategies side by side, the fundamental trade-off you make as an investor becomes super obvious. You're essentially trading guaranteed high fees and heavier time commitments for the highly uncertain possibility of beating the market baseline. With passive, the fees and time required are incredibly low, but your goal is just to match the market. So you're paying a premium and absorbing concentrated risk with active management purely for the chance of outperforming the standard benchmark.
And listen, you absolutely cannot ignore those fees. They aren't just some one-time cover charge paid at the door. You know how compound interest famously snowballs your wealth? Well, compound fees relentlessly eat it in reverse. A 1 or 2% management fee might not sound like a big deal today, but it silently siphons away a massive chunk of your overall wealth over 20 or 30 years. It's a continuous drain on your long-term growth.
Which brings us to Section 4, the long-term winner. The verdict. When we zoom out to a decade or more, the math here gets incredibly stubborn. For active management, trying to consistently beat the market year after year while carrying a 2% fee strapped to your back is just utterly exhausting. Even if a manager has a fantastic year, repeating that success over a decade is mathematically rare. Passive investing, on the other hand, is unburdened by high fees. Without that drag, the simple, steady approach almost always crosses the long-term finish line first.
So you really have to look at the objective data and ask yourself, does a slight chance of beating the market actually justify a guaranteed premium? In investing, returns are never, ever guaranteed. But your costs absolutely are. You're paying a guaranteed premium for a human manager, and you have to decide if that cost is truly worth the statistically slim chance they outperform a highly efficient, automated index fund over 20 years of market cycles.
Let's wrap things up with Section 5, Key Takeaways, Securing Your Future. All right, here's how you actually put this into practice. Building lasting wealth isn't about exciting daily trades, it's a disciplined procedure. Step 1. Get real about your long-term timeline. Are you investing for next year or retirement 20 years away? Step 2. Ruthlessly audit and minimize your investment fees. Cut away those unnecessary management costs. And Step 3. Invest consistently into broad markets and let time do the heavy lifting for you. Just set it and forget it.
The bottom line is this. For the long-term, everyday investor, minimizing costs through passive investing is the definitive winner. The evidence is abundantly clear on this. Unless you're a full-time institutional trader with access to non-public data flows, keeping your money in a broad, low-cost, passive vehicle is the most empirically sound way to win the wealth game. It's a boring strategy, honestly. But you know what? That is exactly why it's so highly effective. I'm going to leave you with a quick piece of homework for today. A final, provocative thought to investigate your own portfolio. Are hidden, active fees silently draining your retirement strategy right now? Seriously, log into your accounts this week, check the expense ratios on your funds, and find out exactly how much of your future wealth is currently being siphoned away. Thank you so much for joining me for this explainer, and happy investing.